Well, hello, and welcome to the Systematic Trading Podcast. And this is just the beginning of this podcast. So I have a first guest, Jarvis. So he's our former student, but I let him to introduce himself, what he does, and who he is.
Good morning, Alexei.
Yeah, morning again.
Um, well, who I am and what I do. Wayne Jarvis. I just retired in May after practicing oral and maxillofacial surgery for 48 years. As that was approaching, I found a need to find a more effective way to manage my retirement investments because now I'm at the point where I have to live off of it. No more income for me for anything else.
Mhm.
So that's kind of why we're here today.
Yeah, great. Yeah, I didn't know that actually you're retired because I remember you always on Thursday you had to do your surgeries
Right.
while you were in the program. Like, oh yeah, I cannot be taking on the call on Thursday because I have my surgeries. So you're actually
Yeah.
officially retired. Yeah, great,
Yeah. May
great.
29th. So that's pretty fresh.
Yeah. All right. Okay, so why don't you tell your trading journey, how you end
Okay.
up to be where you are right now? That would be again probably interesting for everyone else to know. Yeah.
All right. I'll summarize it the best I can. It started roughly 40 years ago when I finally was making an income after spending my whole life going to school. And
Yeah, doctors is always like that.
people always ask how long did it take, and it was 12 years after I graduated from high school. so,
Hmm.
um, so I knew nothing about investments, savings, anything. So I'm talking about in the late 70s. So it was before personal computers, before internet or anything like that.
Hmm.
And so I found some different uh, self-taught courses, basically books and workbooks and things that you could get, audio tapes, just to learn to understand a bit about what the stock market was all about, and uh, decided to try to start investing some of my money. I didn't have any mentors. There was no place to go online to look. All I could do is read books
Hmm.
and open an account and lose money.
Yeah. But what piqued your interest? Why stock market? I mean, just because you were a doctor. I mean, you were training to be a doctor.
Yeah, but I also wanted to be able to put aside money for the future.
Okay. Yeah.
So um, I was trying to figure out what the most effective way was to do that. And, I just heard everybody talking about their investments in the stock market and the retirement
Hmm.
plans and so forth. But I had very little education. And like most people, I just kind of stumbled along. Um, and I would save up some money and I would try to invest it in some stocks, and I'd lose money and panic and get out. And because I had no one to talk to who was experienced about it, and no place to go other than, like I said, books and tapes. So I
Hmm.
was very naive at first, and then. I guess I probably got on somebody's mailing list because I was ordering books and things about this, and so I got a uh, advertisement in the mail for a course on how to uh, trade futures contracts.
Hmm.
And so here's a guy who doesn't even know about trading stocks, and now, oh, this sounds great. Futures
Even more
is,
complex.
yeah, even more. Yeah, it sounds really exciting. And so I found out I could lose my money even faster that way.
Yeah, with all the leverage. Yeah,
And
indeed.
so, I kept doing that. But luckily, I mean, I didn't have any big savings to lose. So, I would blow up an account, but I was beginning my career and I had income and didn't even have any kids yet at that time. So
Hmm.
I would just accumulate some more and try something else. Eventually, I ran across William O'Neill's book, How to Make Money in the Stock Market.
Hmm. Yeah.
And I read that and got very interested in it. I started getting the IBD print newspaper on a daily basis.
Hmm.
And I would go through his book and all the listings in the paper and read the articles in the paper. And it was really kind of my first introduction to the idea that people could have a systematic way to trade. And he has his CANSLIM method that he talked
Yeah.
about for decades. And so I started learning about trading. Basically, I didn't know what it was called at the time, but long-term trend following. I would use the newspaper to figure out what looked like a stock that was a good candidate, using all the parameters that he would publish for his stock checkups, and then look for breakouts and buy breakouts, and tried to follow his system. At the time, his recommendations were to basically trade 10 stocks, find the 10 best ones that you thought you wanted to trade, when they broke out, follow all of his CANSLIM fundamentals philosophy to try to also figure out which the best choices were out of all the candidates, and then divide your equity up into 10 positions and just trade equal cash positions for 10 different stocks, and then have a stop loss at 8%.
It's infamous 8%. Yeah.
and 25% profit target. And so basically, without knowing it and without having it in a very organized way, I had trend signals for when to buy a stock, long-term, trends, breakouts. I had a stop loss and I had an exit. So basically, I had everything you have to do systematic trading. It just was not very detailed and very exact. But actually, I started to make some money that way. And I learned real quick that trading long was great when the market was in a bull market. And the best thing you could do was to get out of the market as soon as it wasn't in a bull market anymore. So there was times when I sat in cash for 3 years, but at least I hadn't lost more than 8% on any of my investments. So I was able to gradually increase my trading equity over time and start to accumulate some savings, and actually, put away more money than I thought I was going to be able to after all of my expenses of life. So, 40 years later or so, about a little over a year ago, I read. Well, let me back up a little bit. The thing that made me start looking around again was I was in a good long-term trend. I made. I can't remember what year it was, but I made about 30% plus or minus on all of my different positions. And then the market started to go down, and I went into cash, and but I wasn't quite sure exactly if the smart thing to do was to still look at 8% as a stop loss or whatever. So I was, knowing that this wasn't going to go on forever, I started searching around and checking about ways to make those kind of decisions. And I, over the years, I had read lots and lots of books. I've got a long reading list, and I read all the books that Michael Covell had written, and which are primarily about trend trading.
Yeah.
And so I took his flagship course to learn how to do long-term trend following. And so I used that to help me get a clue when I would get out of the market. So I got a little bit more systematic with my stop losses and so forth. And then I got stopped out, and basically I was sitting in cash for a long time. And so, I reviewed his stuff, and, based on what I knew, there was nothing else to do to wait till the market went back up again. So I started, I don't even know how I came across Laurent's first book, but I saw the title of his first book, and I thought, that sounds very interesting. So I went online to get it, and I found out that his second book had actually just been published. So I read his second book first. And that's how I found out about the mentorship, and contacted you guys and started talking with you about it. I watched every YouTube video I could find where Lawrence was being interviewed, and then I ran across your name on the TMS website, and
Hmm.
so I watched your videos and your YouTube things, and I went back and reviewed the books, and I said, well, I think this would be a good thing to do. Um, so I set up a call and called you, and you kind of know most of the history from there.
Yeah, yeah.
It took me a while to convince myself that uh, this was going to be as good as it sounded like it was going to be.
Yeah.
And of course, I was very naive too about what I was going to get out of the program compared to what I had gotten from other programs to try to teach me about trading in the past. And I kind of got sticker shock about what the cost was going to be, not only for the mentorship, but for the software and for the computers and everything I needed to do. So I did a lot of calculating in my head and a lot of thinking about the pros and cons, and decided it took me time, as you know, but eventually I decided to make the investment. And
Hmm.
I
The leap
knew
of faith.
from yeah, but I tell you, it didn't require faith for very long. After the first few calls and the initial work that I did with Lawrence, and looking at the software and being totally confused by it, it was much more sophisticated than I was anticipating. But once I kind of learned how it worked, I was a believer. I said, this is going to work. I can make this work. Other people have done it. If they've done it, they can do it. I can do it.
Hmm.
And so I just went at it as strongly as I could. And I made it my priority because I wanted to be able to retire. And I needed to be able to have steady income from retirement. If it were just me, I probably could have just, continued my pretty, you know, basic lifestyle. I'm not a big spender kind of guy,
Hmm.
and I would have had enough money probably to live out the my expected lifespan. Um, but my wife is 18 years younger than me, and
Hmm.
so I knew that if I spent all the money down, there'd be nothing left for her. And women typically live longer than their husbands anyway, so she was going to need something for probably a lot longer than 18 years after I was gone.
Hmm.
So I wanted to. I liked the idea of having systematic trading first of all, because over the years I found all the stuff that you guys teach about the psychology of trading is really the hard part. It's not the mechanics of investing money and
Yeah. It's not
buying
the
and
system
selling.
itself. Yeah. It's not. It's
Yeah,
not the system. It's the how do you deal
and
with it.
and I could relate to all those things because in all those years I was telling you about, all the different biases that you talk about, I had them at one time or another. I made all the mistakes you can make. I
Hmm.
hung on too long because I was expecting it to come back and lost money that way. I
Yeah.
I started making money and got worried about losing the gains I already had, so I got out too soon before the trends were really over and left
Hmm.
money on the table that way.
It's a human
And all
psychology.
these
Yeah.
all these different things. Um,
Yeah.
so that all rang true to me because I had experienced just about all of them over the 40 years before I found you guys.
Hmm.
Um, and I knew it was going to work. I just was a matter of putting it together. And with your help and Lauren's help and the help of the other people on the calls, I think I got way more out of it than I anticipated. I think that the end result is far better than I hoped for. My dream was that if I started doing automated systematic trading and can run multiple non-correlated systems to help increase the annual returns and decrease the drawdowns, um, that would work. I knew that there was an edge there. And I was just hoping that I could create a system that would, on average, generate 10%. Because if I could get 10% return, um, I knew that if there was a system in place that would run itself for my wife, that she'd be able to live the rest of her years on 10% without any problem.
Mm-hmm.
And so I've only been trading live, as you know, since January. So we're coming up to 9 months. So it's not even 1 year. So in the overall
Mm-hmm.
scheme of things, that's a pretty short period of time. But the back testing that we did on all the systems indicated that 10% should be very easy to accomplish.
Mm-hmm.
The final system that I ended up, final suite of systems I ended up with when I started going live, the full suite of 20 systems, back tested from 2007, had a CAGR of 31%.
Mm-hmm.
Now that's back testing, and I did my best along the way to make sure I wasn't over optimizing and to try to make sure that I was doing the things to avoid the big drawdowns and so forth. But I also knew from hearing Lauren say it just about every week on the calls that you could expect to get half your CAGR and twice your drawdown sometime along the way. So be
Mm-hmm.
prepared for that. So I thought, okay, well, if he's right, I've got a system that back tests for 18 years at 31%. Half of that would still be 15, which is way more than the 10% I felt I needed. So I
Yeah.
really was confident that I did the right thing. And luckily, for me, I just happened to start at the right time with live trading.
I
The
mean, you
market,
actually went right before the April low, right before
exactly,
the dive.
which was the perfect time for me because I saw the market going down, and I think the maximum drawdown on the Nasdaq was like around 20% or something at that
Yeah.
time.
Yeah. 21, I
And
think, percent. Yeah. 20%.
and
Yeah.
and I trade two live suites, one for my IRA account, which is non-taxable within the account, but of course limits the types of trading you can do too. No margin, no shorts, no,
Mm-hmm. Yeah.
and a taxable account, which is about a quarter of the equity of the other one, but that one can trade all the systems. So those two systems running together, my total equity at Interactive Brokers, when the peak drawdown came, my drawdown was just under 6%. It was like 5.9% loss.
Mm-hmm.
So number one, I saw when the market goes down, at least this time, my system can really give me a lot of protection against that.
Mm-hmm.
Uh, and also, I learned that I can hang on when the market goes down 20%, and I was okay with it. I had perfect confidence that it would come back eventually. Didn't know when that would be or what point my equity would be at that time, but I knew it would happen.
Mm-hmm.
And I knew that I would be protected along the way, that I wasn't going to, the account wasn't going to blow up, because if at worst case scenario, I'd basically go to cash with all of my longer systems and eventually, and the other side with the taxable account, I could have other short systems and so forth that would help. So I just comfortably waited and just watched. I thought, here's a good chance for this to prove out what I thought I had done, and in terms of developing a system, and just sat on my hands. I wasn't going to try to adjust anything or fix anything or do anything different. I was just going to trust in the process, and then it started coming back around. And basically, it's been pretty volatile, but we've had a pretty good overall uptrend, even though it's been up and down on the way like usual. And this was a fairly volatile one.
Mm-hmm.
But I'm just looking right now to tell you exactly where I stand as of this morning after being down 6%. See if I can find this. It'll be a combination of the two accounts put together.
Mm-hmm.
And this will be the performance,
Including all kinds of
numbers.
hiccups in between. It wasn't a smooth ride, right? Yeah,
all
there
the
was
things along the way. Yeah, and I'm afraid that I'm squinting at my phone here. I should put my glasses on so I can see this. There we go. I got it now. But so this is both accounts together, the taxable and the IRA account, the total performance for year to date since I started on January 21st is 22.01%.
Yeah, which is better than the market itself, if you think about it,
Yeah, and it
and
was
a lot smaller drawdown than the market did, because even S&P 500 went down 18 something percent in
right.
April,
So
right? And the Russell 2000 was 23%. I forgot the exact number, but it was like basically more significant. Yeah.
So that basically convinced me that systematic automated trading could minimize my drawdowns when the market goes south, and I could beat the market on performance when it goes up. Now, next year will be a new year, but it just showed me that it's possible. It's not far off from what we expected after doing all the robustness testing to try to get a more realistic view. And I could never have done it without all the training and education I got from you guys, number one. But even if I knew how to do that and create the systems without it being automated, my two suites generate on average since January about 140 trades a day. To sit and try to make 140 orders submitted by hand accurately, timely, before the market opens every day. I could never do that. And even if I could, it wouldn't have left me anything that I could leave to my wife to go on afterwards. Because, I need something that's going to run automatically for her too.
Yeah.
So I really feel like it was the best decision of my life. So now I'm retired and living off my investments, which 40 years ago, I didn't think I'd ever be able to do that. I didn't think I'd be able to make even any money on investments, much less live off of.
Well, I mean, we all go through that same journey per se, that the first several years you lose money a lot. Right. Then that's what distinguishes, like when they're saying, oh, there are 90% of traders that fail. What does it mean fail? That means that usually they either run out of money or they lose confidence completely. So they don't want to even touch trading anymore. They're like, okay, somebody else has to do it because I cannot do it myself. And usually that's like if you read, was John Carter in his book, he says, okay, the typical journey, you're first a novice, right? Now you're all excited. You go and create the systems, and then you start trading, and then you hit the first bump. You kind of survive that, and you hit the second bump, third bump, and fourth bump, whatever the next bump is. And then at some point, either it breaks you completely, that you just give up eventually, or you start to be maybe break even. And as you get maybe more break even, then by year around 3 to 5, this is where you start to actually be profitable. It's almost like it doesn't matter what you do, because first you're just doing too many mistakes. And usually this mistake, you just can't admit them that they're mistakes, but that's what usually happens, right? So by year 5, by year 3 to 5, this is where you start to be profitable and actually start to make money. And that's where usually people completely fall off. Whoever, if they're not making money, they just stop trading altogether, right? So, and but majority of the time it still relates to the actual psychology. It's not the system that you have. As an example, the CANSLIM system, it's a great system for bull market only, right? It blends together the fundamentals with the technical aspects. It's kind of complicated if you think about it, because there's so many things to pay attention to. That is why you only have discretion. It's too much discretion, because you need to do, on the technical level, it's this way. And on the fundamental level, it's that way. And there is no right or wrong, because companies can redo their own earnings. Like, that's, if you read especially all those like an Enron blow up, right? Or the financial crisis of 2008. There are so many companies like the same Goldman Sachs or whatever it is, like Bear Stearns at the time. They did in the past, like up to 3 years of redoing their own stuff, like Lehman Brothers. They whatever the earnings they reported, it's not even necessarily the right earnings. So whatever you do may not be the right thing to do anyway. So there's no right or wrong. But if you have only one system, you're at the mercy of that system. And that's why if it's too volatile or too unpredictable, because there is still too much variability in any single system, then I don't know how you can survive it. Yeah. And that's why people sometimes jump around between systems, right? So the They hit the bump on the first system. It's like, oh, it's a wrong system. It doesn't work. What do you mean it doesn't work? It may not work right now, per se, but it works in the grand scheme of things together, right, with other things. It's like a lot of times when we have a whole portfolio of systems, you plug in the new system into the portfolio, and by itself, the system is measly. I mean, it doesn't make much return, but it does make return exactly when you need it, and all of a sudden you have a boost in your system, right, in your total, in your suite
Right.
of systems. And that's
Exactly.
the kind of the thing that we preach. It's not the single system development. You should not have a collection of systems. You need to have a unified suite of systems, not just a collection, right, of
Right.
systems. And that's what we're trying to teach. So, and hopefully, I mean, that's what that basically gives you this more confidence that it will work, because it's not just any single system which works in a certain environment
Right.
only. You have different things for different environments and different approaches for different environments. Obviously, you can still make it better if you want to. You can create more systems, more sophisticated if you want to. But at some point, you may say, well, you know what? I can just let it run. Let it run. It is what it is, but let it run, because it will cover 90% of what you'll encounter over there in the market. That's the reason why, again, half the CAGR and double the drawdown, because there's still this 10% that may not be covered. something
Exactly.
may something may happen that it will cause bigger drawdown. But what are your personal? I mean, you have a basically you kind of, without me even asking you questions, you kind of outlined everything, right? But I'm just curious about a couple of things from what you learned, not necessarily from our um, uh,
Right.
mentorship, but just in general, from systematic trading perspective in general, like any kind of life changes, life lessons that you learned. Uh,
Well, follow the rules. That's really, um, you can have all kinds of good ideas about how you want to trade, and you can make up a system, and it can be, CANSLIM or anything else. And if you don't follow the rules, it's not going to work the way it's supposed to work anyway. So even if it is a
mhm,
good system, even if you create the best system, if you try to intercept it and put your discretion into the rules when things don't go the way you think you're supposed to on that particular day, it's not going to work. And so I think that's probably the biggest lesson I learned. No matter what, my biases say, oh my God, I've got 50% profit on this trade. I got to get out of this before that goes away,
mhm,
because,
yeah,
it'll make up for the last, three 15% losses I had.
mhm,
But that's not the rule. The rule is if it's long, let it ride until the trend ends, and your rules tell you to get out. But um, and it's same in the other way around too. The drawdowns start to come. You've got to know that that's part of what your system is designed to deal with, and you've got to follow the rules. You can't get out until the rules tell you to get out. And for me, and probably for most other human beings, to have a good set of rules and try to follow them exactly every single day is almost impossible, because as humans we have too many biases and too many fears and too much greed and all the
mhm,
different reasons
yeah,
that we justify in our own heads why we're going to go in and tweak the system a little bit that day, and that's a mistake. So having it be automated is the second big life lesson. First of all, you have to follow the rules. Secondly, you can't follow the rules because you're human. So thirdly, you
you
need
will
to have
tend
an
to
automated
overrate them,
system.
right? Yeah, yeah,
So um,
yeah.
I guess that you could go into more detail on all those things, but the psychological part of it is so much of a factor, and it's not just with trading; it's with everything in life. Yeah, we we probably know the rules for all the things that we shouldn't do in our life, but we have our biases, we have our psychological problems, we have our dysfunctions, and we break the rules, and things don't go the way they should.
Mhm.
So I mean, it's an overall life lesson. Follow the rules, and you'll do better. But then human beings can't always follow the rules. So that's where the computer comes in. So in addition to that, I did that systematic trading with IBD for a long time, probably almost 20 years.
Mm-hmm.
And I did slowly ratchet up, but there were some periods of time over there where, I first lost, 10, 12, 15%, and then went to cash and stayed there at that drawdown position for 2 or 3 years before it was time to get back in, if that's the only system you've got and the only, way of trading that you've got. And it's hard to do that too. It's hard to follow that rule because you're sitting there for 2 years and you're, 2 years closer to retirement and your equity's not getting any bigger and inflation's eating away at it. And you say, gee, I got to do
Mm-hmm.
something. So then you start looking for ways to go in and that you don't have a system for. And that's a mistake too. So,
Yeah, exactly.
But even just following that one system, following stocks, looking for setups, trying to keep 10, positions active all the time with good enough breakout trades to achieve what you want to do. That's a lot of work. And that's just one system and it's only 10 positions. And as you start putting together more and more systems, which are really the key to the whole thing, as you pointed out, it's not just having 10 systems, but they all have to be synergistic with each other. They all have to help each other in one way or another
Mm-hmm. Exactly.
to be kept in there. And that's a lot to keep track of. And before long, at least for an old guy like me who doesn't have the mental capacity he had 40 years ago, trying to do that manually, be too many mistakes. Even if I had the system to tell me exactly what trades to make and how to do it, and I followed the rules, just sitting down at the computer and trying to get it all entered in with all the keystrokes without making a mistake anywhere,
Mm-hmm.
or without forgetting something, or just. And plus, if you're doing it all manually, at least from my perspective, that's just another chance for me to let my my psychological dysfunctions take over, my biases take over, and say, maybe I should
And override,
change this
right?
one a little
Yeah.
bit. Maybe I'll change this one a little bit.
Yeah.
So even if I could physically make all of those entries every day and didn't make any errors, I still might, be tempted to shift gears along the way instead of just letting the system run. So I think the automated part of it is huge. So it's not just having systems, but if you have it computerized. And I mentioned earlier that I read all of Michael Cavell's books
Mm-hmm.
and then listened to them again on tapes when I was driving to review everything too. And most of the people that he gave as examples for how long-term trend following can work, and it can work over a lifetime, were guys that started far enough back that they had enough decades to prove that worked, and a lot of them have built very big businesses and very big personal wealth and so forth. And almost every one of them, from Ed Sakota on, they did it by writing their own programs, so it could be automated for them. So the
Yeah.
idea of automated trading is not new. It's been around for 50 years, as long as computers have been around.
Mm-hmm.
But it didn't really become very common, I don't think, outside of some of those individuals that built their own software, built their own computer systems, spent who knows how much money. I think Tom Basso mentioned to me one time that he spent over $1 million with writing programs and paying programmers and buying
Mm-hmm.
computer equipment. And back when $1 million was a lot of money.
Yeah.
And there's very few people in the world that did that, but it's a good example that that's the way to go, and that they're still around decades later. Some of them have very big investment firms, the ones I'm talking about,
Mm-hmm.
that have been doing automated trading and haven't changed their systems for 30 years. And they just
Mm-hmm.
trust the rules and they let it go, I love listening to Ed Sekota's Whipsaw song. It's it's kind of comical and it's a little corny, but it basically all the secrets are right in that little song, and it all has to do with following the rules. And
Yeah.
now
I
when you
mean,
go out on,
that's the key secret to it. The whole thing is following the rules. It's just
yeah,
as an example. Yes, you're totally right. It's you tend to, if let's say you go with the CANSLIM, right? If you go with that approach, 10 positions only, because it's 10 positions, and let's say you're trading big account, huge account,
right,
significant account. For a lot of people, let's say $1 million is a big account, right? So you're trading. So each position is $100,000 position at minimum, right? To just to
right,
get in. And because of this, you will have so much temptation to overwrite whatever the system says,
right,
right? Imagine that, let's say, each position, then you have 200 positions instead of 10 positions. There are so many positions, so many different rules, so many different things. Yes, you do need automation, but it not only requires you to automate it, it requires you, it makes you to actually stop looking for each and every position as if it's an individual position. They become just a position. It's just a
yeah,
blend of them, right? There's
sure,
so many that you cannot possibly anymore taking care of any of them. You will not even have temptation to take care of any of them,
right,
right? So that's the key reason that when you have lots of different systems with the automation, then it gives you even more confidence that it's going to work because you have less temptation to try to even interject your own personal self in the middle of it. At least that's my take of this part. So yes,
yeah,
exactly, you're right. It's just I'm trying to kind of like emphasize that what I personally know, that when I look at my suite of systems and my positions, and I know that each position is small compared to my total, then I really don't care which each position does. I just look at the
right,
general overall where I'm moving. And since I cannot really predict where exactly I'm moving, because again, there are so many different positions, I know approximately based on the behavior of my suite of systems. So I know my suite of systems inside and out from the behavior perspective and not no longer position by position perspective. I really don't care which position I'm in at this point in time. I know the tickers, I know the names, it's kind of expecting them, and sometimes it's kind of nice that you see the look at the you open up and like, oh, I'm in this one. Yes, it's a good one. I know that it's like if I were doing the discretionary, I would be in that one. But great, it's a small position anyway. But overall, it's like it requires me to pay less attention to each position. I just look at the outliers. That there's something wrong, because there's some hiccup. Not with even with automation or something else is coming across that causes the bigger sway in some position, right? So then again, I would modify later for my own suite if I need to dump things down. Like when I learned that one of my positions was too big because it was commodity, it was natural gas, and natural gas is very up and
volatile,
down, kind of like a very volatile, right? It goes up and down crazily. So it was affecting me too much. So I had to reduce the position of that, even though my back testing was suffering per se. But again, who am I kidding? Do I need to have a beautiful back test, or do I need to make money so I can actually make money and survive by making
right,
money? Right. So I reduced the size of that position and be damned my back test. I'd rather make money and be sleeping at night versus just seeing my P&L be swayed by one position versus the 200 the others in place are not doing as much of an impact as like one of them, right? So that's my personal take on this kind of a thing. So yes, you totally nailed it basically. Any other topics you want to cover for today? Because I think we've covered a lot on
yeah, I think we have.
systematic trading in general.
I guess just to add on to what you were just talking about, when I was trading 10 positions, each position is obviously 10% of your equity. So,
Yeah.
you know, every night, every weekend, you think, okay, so what's going to happen this weekend? What kind of corporate event is going to go on? Are they're going to find out that, their chief financial officer has been embezzling from the company, or they're going to find out
Mm-hmm.
that there was a big lawsuit against them, a class action suit, or what kind of thing is going to happen to make their price, gap down 20, 30%. overnight,
Mm-hmm.
and
Yeah.
your 8% stop doesn't do you much good there. And if you got $100,000 in your position, and the company goes bankrupt, you're going to lose $100,000, 10% of your account. But if you got $1 million account and you've got, you know, 500 positions, then
Yeah.
you don't worry about that. If one company goes south, not only is it not going to cost you that much, but one of your other short systems might pick up on that and make you money on it anyway. So
Mm-hmm. Exactly. Yeah.
the more positions you have, the more you have that equity spread out, the less fear you have about what's going to happen.
I mean, the old adage of diversify. That's
Yeah.
what it does, right? It diversifies. But how do you diversify? When you do a discretionary basis, sometimes people say, oh, put something into the large cap stocks, put something into the small cap stocks, and then you use the micro cap stocks very sparingly a little bit, and then put into international stocks, put it into this sector, into that sector, and it makes it so complex. So that's why when you go to a bank, then they're trying to dazzle you with this kind of info, putting all kind of brochures and saying that this is your composition. But in reality, if you look closely, they're just resembling S&P 500. That's pretty much what they do, right?
Right.
With all the with all the stuff in there, it just sounds very scientific, but in reality, they're trying to use the diversification, but in reality, it's not as diversified as you think it is.
It's very little diversified. I used to think
Yeah.
that meant a lot of diversification. When I was first starting into that trend following course I told you about, Michael Cavell's
Mm-hmm.
flagship
Yeah.
course, and he talked about diversification, and basically he was basically just talking about having, investments from multiple different sectors, all the different sectors.
Mm-hmm.
But you're still, how diversified is it if you're buying stocks from every sector out there, but you're trading them all with a long-term trend following system? And they're all going to go up and down. When the market is going sideways, you'll have a lot more variability between what those stocks do. But when the market really starts to drop, or even when it really starts to have a really strong bull market, they're all going to be correlated with each other, and you don't
Mm-hmm.
have
Yeah.
so diversification is not probably even the right word. Non-correlation is probably a better concept to think about, so that they're not all
Yeah.
moving the same way at the same time.
Exactly. Exactly. It's not just diversification, because if they all go down, they all go down,
Yeah.
right? Yeah, you think that you diversify that, like in 2022 example, people who had the traditional 60-40%, 60% equity, 40% bond, because in theory that's supposed to be diversified, right? Not in 2022. The bonds were going down even faster than the equities, actually,
Yeah.
as a matter of fact, right? So your diversified portfolio was just playing, tanking real fast. So that's just, again, the traditional view versus non-traditional, and that's the reason why what we do is systematic mechanical trading. Mechanical part, that's the automation portion, right? So you don't just have any kind of discretion interjected into it. But this one at least gives you much more peace of mind, in my opinion, of how to protect your bottom line. So just in case if something tanks, it doesn't matter how you think it's good. If it tanks, you need to get out, and you need to get out by certain rules. Like right
Right.
now, everyone talks about cryptocurrencies, right? It's still hype about the cryptocurrencies because it was hitting all-time high just a few months ago. So, but if you think about it, you have to have rules. You can't just rely on the
Right.
cryptocurrency and say, okay, I'm going to just hold on to it because it's going to hit $1 million for Bitcoin. Maybe it will hit $1 million of Bitcoin sometime, but maybe it won't. You don't know. Meanwhile, you still have your life to live, and you may not have money while it's not hitting the $1 million yet, right? Mark.
It'd be like my friend who wakes up in the middle of the night to go to the bathroom, but he's also got to turn on his phone so he can check and see where the cryptocurrencies have gone overnight.
Yeah, exactly. It's just you need to have certain rules. You can't just, because Cryptocurrency is almost the same like the stocks were back at the beginning of the century, like the 20th century, right? Where people had no computers, no technologies, and some people were just buying. And that was why in 1929 there was this crash, because there were people who were just holding on to stocks, and the stocks kept going down, down, down.
Right.
So you need to have a way to get out. Cryptocurrency is the same exact thing.
Yeah.
It's supported by nothing, by people
Right.
psychology. That's all it's supported by, right? There's no gold equivalent which backs it up. Like, no, there's nothing. Like, at least in companies, in theory, the company has a certain number of products it creates, some certain kind of something in it, right, to support the stock price for it. But cryptocurrency literally is supported by nothing, if you think about it.
Yeah.
It's just whatever the other people think it should cost.
Yeah.
Should be priced at.
It's based on hope.
Yeah, literally. So it goes up just because of there's the scarcity of the supply,
Right.
and somebody else wants to buy it. So that's how it goes up by price. That's the only way to go up by price.
And yet, even as intrinsically, there's some value to it. I suppose you could get big arguments. I don't want to say that, but you don't really have to know about cryptocurrency or what it does or how it does it, or if it's going to do it or if it's not going to do it. It's just another market. You can trade it as long as you have a good system for that market and you follow the rules of that market.
Exactly.
You could trade cryptocurrency just like you could trade corn.
Yeah. Exactly. Yeah. So not to be too long for our discussion, which is a very nice and very interesting insights from your side as well. So any last words to wrap it up, or do you want to say anything? Yeah.
I've probably used too many words already. I tend to get long-winded. I had 7 daughters, and I remember listening to the older one telling one of her younger ones one time, says, if you have a question, ask mom, because you get the dictionary answer. If you ask dad, you'll get the encyclopedia answer. So even my young kids knew how long-winded I was.
Well, it's good anyway. So it's been great and very insightful. So really thank you for this episode, and I think we can just depart for today, but then we will probably meet again at some other time, maybe down the road. Tell the story, continue telling the story, because it's never-ending story with the systematic trading.
Okay,
right?
Well, I always enjoy talking with you, Alexei. Thanks a lot.
Okay, thanks, Wayne. Okay,
Bye-bye.
Bye.